Hello, and welcome to the short video, which I'm quickly going to have the look at the employer national insurance changes that was introduced on the 6th of April 2025. I'm specifically going to have a look at how these changes would affect directors of limited companies, and I'm going to do a few examples to ultimately work out what is the most tax-efficient salary for directors to pay themselves now from their limited companies. But let's quickly have a look at the summary of changes that was introduced on the 6th of April 2025. Firstly, what they've done is they've reduced the employer national insurance threshold from £9,100 to £5,000. What this means is before, you didn't pay any employer national insurance if your salary was lower than £9,100. They've reduced that to £5,000, so a significant reduction there in the threshold. Then what they've also done is they've increased the amount of NI that you're going to pay from 13.8% to 15%. And then a little bit of good news, they've increased the employment allowance from £5,000 to £10,500. But just remember, if you're only a director in a limited company, then you don't qualify for that allowance. But let's have a look at some examples to see what all of this means. Firstly, just to compare like for like, let's just have a look at a simple example to compare the same thing from before April 25 and after April 25. In this example, I've used a salary of £9,096 because a lot of directors actually paid in that salary. And remember from the previous slide, you didn't pay any employer national insurance when your salary was lower than £9,100. So on that salary, there was no employer, employee, NI, or PAYE tax payable. So made things really nice and easy. If you then look at the calculation in a company, what will it look like for the take-home pay for the director and shareholder? So let's say the income is £20,000, less the salary of £9,096, gives you no taxes payable on that. So you just take that, less that, gives you the profit in the company. You will pay corporation tax, just use 19% in this example. If you deduct that, you will get profit after corporation tax, which is what you can pay out as a dividend to yourself. So you take that dividend plus the net salary, less the tax that you will have to pay on those dividends, and it will show you that you would, before April 25, you would clear £17,503. If we now look at this doing exactly the same going forward, what will happen? So on that salary of £9,096, because it's more than £5,000, you will now have to pay employer NI of £614. Now this complicates the calculation, or really changes your calculations quite a bit, because that employer national insurance is actually a deductible expense in the business. So let's have a look at what happens here. So you've got the same income, less employer NI, less the salary, gives you a slightly lower profit before tax in the business, which will reduce your corporation tax slightly, which will reduce the dividends that you can pay out slightly. And then at the bottom, if you take net dividends plus salary, less the slightly lower tax on dividends as well, ultimately it will show you will now be able to clear £17,049. As you can see, you are losing out on £454.12. At the bottom here, I've just made a quick summary of the net effect of all the increase in employer NI and the reduction in dividend tax and corporation tax, how you reconcile back to that amount that you've lost out on. But now the big question is, what is the most tax efficient salary to pay yourself going forward? Okay, so I've done 3 examples here. The first one, I've done £5,000 salary, then £6,500, and then £12,570. As I've said before, on £5,000, no employer NI is payable. Neither you don't need to pay any employee or PAYE tax. So if you take the dividend, or you take the income in the company, less the salary, gives you profit. And in this example, you will see you will clear £39,166. In the second example, I've used a salary of £6,500. The reason for that is this is a salary that you need to earn to be able to qualify for the state second pension fund. But because that is more than £5,000, you will now have to pay employer national insurance of £225. And if you run through the whole calculation, you will see you will be able to clear £39,260 based on that salary, which is slightly better than the first example in any case. The only thing here is there's going to be a slightly more admin because you're going to have to pay those employer NI over to HMRC, where a lot of directors didn't pay any PAYE or NI before. But at least you are still better off on this calculation. And that qualifies for the state second pension fund. Then in the third example, I've used 12,570. And the reason why I've used that salary is because this is where PAYE and employee national insurance kicks in. So if you only pay that salary, the total amount of employer NI is 1,136. But if you run through the whole example, then you will see you will clear £39,639, which is the best result out of the three. So it looks like most directors will move now to paying themselves £12,570 going forward, as that's the most tax efficient salary to pay yourself. As I say, there will be slightly more admin because we've got to deal now with the employer national insurance that we've got to pay with HMRC. But overall, this is where you are the best off going forward. I hope that was useful. If you have got any further questions, then please let us know. Thank you so much.